Hi everyone, welcome to another extremely interesting episode of the Fisdom Wealthpeek, where we seek to demystify the most interesting and the hottest NFOs that are lined up for Indians. So today we are going to be talking about an extremely interesting NFO that is to be launched from the trusted house of ICICI Prudential Mutual Fund, and with us we have Chintan Haria, who is the head of product development and strategy at ICICI Prudential Asset Management Company. And the fund that we are going to be talking about is ICICI Prudential Nifty Alpha Low Vol 30 ETF FOF. So the name might sound overwhelming, but don't worry. That's what this episode is about, right? To demystify and lay it out straight for you. So Chintan, a very warm welcome. Thanks a lot for taking out the time.
Thank you, Nirav.
So Chintan, first things first, okay? So while going through the product literature brochure, it came to our notice that the fund claims to follow a multifactorial style of investing. So first off, what is a factor? Okay, so what is a factor? And then perhaps if you could go on to explain what is a multifactorial style of investing.
Sure. So effectively, if you see, Nirav, factor is nothing but a way of either choosing a stock. So let's say value as a factor. So those stocks which are low on price to earnings, price to book. Let's say growth as a factor, the stocks which are growing fast either on sales or on profitability. Then you have basically in this current context, alpha and low vol. And as you mentioned, the name is long. The reason why the name is long is it is self-explanatory for an investor to know that it has got alpha, it has got low vol, it has got 30 stocks, right? So it makes it easier for the investor as well to understand. And of course, it is a fund based on an ETF. So everything is there in the name itself. But to answer your question, the other factors, for example, like alpha or low vol. So a fund manager, when he's managing a fund, basically goes through many factors in his mind while picking and choosing a particular portfolio and making a particular portfolio or stitching a particular portfolio. In the case of smart beta ETFs, which are catching up globally, you can have either one factor on which you can basically create a portfolio. So you pick a universe of stocks, let's say top 100 stocks, and you pick up 30 stocks out of that. And you pick those stocks on the basis of one factor, that is, let's say, the low volatility as a factor. Then you have the ICICI Prudential Low Vol ETF, which is also another product which is existing, right? So in this case, we are talking about India's first multi-factor smart beta product, which was launched in August 2020. The ETF was launched in August 2020. And now for our non-demat based investors who necessarily do not want to trade in ETFs but want to participate in smart beta fund, we are bringing this fund of fund which essentially will invest in ETFs. So from an investor perspective, this fund of fund is giving access to smart beta concept, smart beta multi-factor concept. And like you said, factor is nothing but the particular way in which you choose the stocks. It could be value based, it could be growth based, or it could be combination of two, like it is alpha and low vol.
Understood. So this fund is going to be based on an index, right? The Nifty Alpha Low Vol 30 index. So could you throw some light on how is this index managed? Like what are the principles based on which the index is constructed, and what are the elements of this index that an investor should be informed about?
Sure. So as you are aware, the fund of fund is based on the ETF and the ETF is based on an index, which is how it works on the passive side. So we are replicating the index in the ETF, and the fund of fund is a vehicle through which you invest. Now the index itself, like you said, is managed by the NSE indices, which is essentially the index company. And the methodology of the index is very simple. First, you need to define the universe, which is essentially which are the stocks which will pick up for the purpose of selection. And the stocks are among the top 100 names in large cap and 50 names in mid cap. So this is our universe of stocks, that 150 names, 100 in large cap, 50 in mid cap. Out of these 150 names, then there is filtration which is done. Basically, you apply the factor of alpha and the factor of low vol. I'll explain what is alpha and low vol in subsequently. But you basically put alpha factor and low vol factor, you filter that, you give equal weightages, and you pick the 30 stocks which have the highest score basis alpha and low vol. And then you basically create the index where the weightages are also based the market cap and the score. So essentially these 30 stocks are a culmination of alpha and low vol as factors, and the investor gets a replication of that. And as we've seen in the past, it has done well from a thought process perspective, because alpha is essentially nothing but returns, volatility or low vol is nothing but stability. So if you have a combination of stocks picked up from the top 150 names, so to say, and having, let's say, returns with stability, it's a win-win portfolio, a very good way for investors to participate in the market for the long run.
Right. So you briefly touched upon the elements of low volatility and also how it is trying to capture an alpha and deliver performance. So if you could just flesh this out a little bit and talk about what are the objectives of this fund that you would like to achieve through, this particular route.
So essentially, the idea is basically speed with stability, returns with stability, if I may use the term. Basically, you pick up those stocks which are doing well, but you cannot pick up stocks just because they're doing well. You need them to be stable as well. So it's a portfolio which will fit all the investors who are looking to participate in the market in the long run. And the objective is to pick those stocks which are basically doing well in the market and are stable. And we've seen in the past as well, I think 8 out of the 11 calendar years, it has been able to beat the broad market Nifty 50 index. And even in this year, this calendar year of 2021, it is beating the Nifty 50 index because of the fact that you are choosing those stocks which are doing well and are stable as well. So there's inbuilt stability or safety net as well in terms of picking the stocks. You're not just picking the winners. And also because the universe is top 150 names, these are reasonably liquid, well-known names. And hence we believe from an investor fit perspective, this is a good addition to the overall investor portfolio.
Right. So would it be fair for me to take away that this fund is going to be extremely focused on delivering highly risk optimized returns to investors? Could that be a fair takeaway?
So that's the beauty of smart beta factorial indices, that the investor exactly knows what are the factors that he's getting into. And like you said, one factor is low volatility, which is essentially stability in bid, and you're picking up winners. So winners with stability, and hence on a risk adjusted basis, this should do well relative to, let's say, from a broad market perspective, given that you're building in an element of stability while selection of stocks.
Right. So for our viewers who are, not very familiar with what risk-adjusted returns are, would you like to just explain in very brief that how is risk-adjusted return different from just returns?
Sure. So as you are aware, in India, generally when investors are investing, they look at what are the returns of a particular theme, and then the best return gets the maximum allocation, which may not be the best way to invest because you cannot invest looking at the past returns. The reason for that is the past returns don't tell you the amount of risk that is being taken for generating those returns. For example, typically small caps or themes which are doing very well, they have a higher element of risk because they can essentially fall also a lot more. And a theme typically, look at, let's say, the 1999 tech bubble, the 2008 infrastructure / capital good bubble, or the real estate bubble at that time. And in 2017, we had the small cap, mid cap rally, which was very, very, steep or very, very sharp. All of this, essentially, you basically look at the returns, but you're not looking at the volatility or the inbuilt risk that is there. And the concept of risk-adjusted return is that you basically look at the returns, you look at the risk as well as measured by the standard deviation of that particular stock. Standard deviation is nothing but how volatile is the return from a particular stock. And then you basically marry the two and see the risk-adjusted return. So essentially, returns as a concept is pure numerical, while risk-adjusted return is you are looking at the returns with a layer of how much risk has been taken to generate those returns. And that essentially is a good fit for you to realize that on a risk-adjusted basis, if a portfolio is good, you end up being better off because you'll not always get it right in getting the theme at the bottom or getting into the small caps at the bottom, while actually if you go enter at the top, you can actually lose a lot. So risk-adjusted return is a very strong and powerful concept, which you should always keep in mind when you are looking at longer term returns of any particular product.
Understood. So one final question for this particular NFO, what kind of investors is this more suitable to? Perhaps you could talk about the kind of risk profile or the kind of time horizon that one should keep in mind before entering such a fund.
So clearly, those investors who have appetite for equities is one, and their investment allocation or asset allocation allows equity investing, they can invest in it. It is not necessarily a product where only aggressive investors can invest. I would believe all kinds of investors can invest in this product because of the nature, like I explained and you mentioned, it has got an inbuilt stability or low volatility. It is not just pure momentum. It is not just pure alpha. If it was pure momentum and pure alpha, then obviously the risk would have been higher and the risk-adjusted return would be lower. But as a combination of these two factors, it is bringing in stability as well. And hence, all investors who have a longer-term horizon, I would say 3 to 5 years at the minimum, or looking at equity allocation, this has borne fruit in the long run. The past returns have been showcasing that you're picking up the stocks. In fact, you probably, just to elaborate on the methodology, every 6 months, the portfolio gets churned from an index perspective, and those stocks which are forming part of the index come in, those stocks which become volatile or returns go weak, they go out. So this is also an inbuilt mechanism wherein you keep updating the portfolio and the investor keeps benefiting from different sectoral and stock exposures based on the selection methodology. So we've seen in the past that it has worked well for all kinds of investors who are looking at pure equity funds, and hence from this FOF perspective also, it being an equity taxation product, investors across the category looking at long-term allocation for equities may fit in this as an asset allocation or as an allocation for their equity product. Thank you.
Understood. So Chintan, this brings us to the close of this conversation. For the viewers, once again, this was Chintan Haria, the Head of Product Development and Strategy at ICICI Prudential AMC. And we spoke about the ICICI Prudential Nifty Alpha Low Vol 30 ETF FOF. The NFO is going to be out soon. And I really encourage each one of you to take a close look at it and see how it can add value to your existing portfolios. So Chintan, I am extremely confident that investors are going to love this product. It is solving a purpose. It has merit as an idea, and I can clearly see it being placed within most mainstream portfolios as an allocation. So Chintan, thanks a lot for your insights into this fund today, and I'm extremely confident you'll do extremely well with this NFO. All the best and good luck for it.
Thank you, Nirav. Thank you to investors as well. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.